So joining us now is Ken Shinoda, DoubleLine Capital Portfolio Manager, and Mona Mahajan, Edward Jones, a Senior Investment Strategist. Great to get you both on set. We really appreciate it.
Thanks for having us.
Okay, so it's a rapid fire. Did the market make sense to you after the Powell?
You know, I think it did because they were hoping for the 3 cuts to maintain. They got the 3 cuts.
They got the 3 cuts. Was it? Yeah.
Yeah, I think it was. You know, what happened? It happened how they expected it to. That they need time for inflation data to come in. They need time for economic data to come in so they can make their next move, and they want to cut this year. It's pretty clear.
He didn't push back against financial conditions. He could have. He was asked about it twice, last time during the last FOMC and this time. Should we read into that?
I don't think so. I think that financial conditions have definitely improved. Equity prices are obviously up on that. Credit spreads have come in on that. And, you know, the economy is doing okay. So I think it's steady as she goes from that standpoint.
Okay, but Mona, is it worth 5,200 on the S&P? Like, is it, I mean, they did take a cut out for next year, but it's like equity markets doesn't care.
Yeah, you know, I think one of the concerns of the equity market was that inflation was going to go in the wrong direction. And actually, Jerome Powell, I noticed, said twice in this press conference that he thinks the overall trend, inflation will move down gradually to 2% on a sometimes bumpy path. He didn't push back and say January and February are the start of a new trend higher, that we might pause interest rate, the cutting cycle. He said the story remains intact. Inflation will probably gradually cool from here. The Fed will probably pivot to rate cuts. And by the way, the economy is holding up better than expected. So this is what the market wants to hear. We saw those small caps rally on that.
It's kind of true. Like when I tell my kid, probably you can have dessert, like she hears, I will have it now. So like, I guess that's what the market is doing. What about the bond market? Eventually, is this going to turn into a steepener trade?
Well, the steepener is happening right now. I do think eventually that it's more likely for the front end to fall more than the long end. So we like a steepener at DoubleLine. What I think that the Fed is very hesitant on is they were so late to hike rates on the way up. And they were viewed to be behind the curve. So they really don't want to be late to cut rates. So they want to start down the path of policy easing in case the economy does slow. And if you look under the curtain a little bit, I know stocks are at all-time highs. I know some economic data is coming in positively, but the yield curve is still inverted. Leading economic indicators have been negative for almost 2 years now. Manufacturing PMI is still in a recession. And the consumer, who's been kind of the saving grace of the economy, the pent-up savings that they got with the stimulus checks from the pandemic, every day that goes by, more and more of that is being spent. So if we look at consumer delinquencies, they're starting to rise. So these are kind of, they're not a red alert for us, but you know, wait and watch and see, is that consumer spending going to hold up? Because if the consumer spending slows, then the economy will go with it.
What does data dependent look like now if the Fed is, you know, biased to cut?
You know, what the Fed is watching now is the different components of inflation. We had a really good run of core goods coming down, supply chain issues being fixed. That services inflation, the housing inflation's kind of been sticky. So I think they want to see housing inflation come down. I think they want to see the job market loosen up a little bit, so service inflation come down. And what they're worried about is that you are seeing kind of signs of life in the economy and purchasing activity. And so what if goods inflation that has been driving inflation lower, what if that ticks up? I mean, that's their worst case scenario. So that's why they want to wait, give it time, wait till the summer and see how things play out.
It really feels like, Mona, that the minutes might be actually more market moving when they come out in 3 weeks' time than today's announcement.
Yeah, it did feel like the 3 rate cuts that were priced in very close from an FOMC participant perspective. In fact, if you take the average, it was 2 rate cuts. So we're on the margin here. It'll be interesting to hear the commentary, who was for, who was against, and for what reasons. I think to Ken's point, inflation will be the key to the story. And we are, you know, Jerome Powell is still holding on to this notion that shelter and rent inflation is operating with a lag, and we'll see it come through. He said at some point this year that should continue to put downward pressure on core inflation. We are hopeful that happens. I think markets are hopeful that happens. We haven't seen it happen yet, and it's been over 6 months of this trend. So I think we need to see that real-time housing rental data come through with a lag in CPI. Keep in mind, though, PCE inflation is what they project project, and that's still a little bit less in the overall basket. The weighting in PC is about 15% shelter and rent versus 33% in core CPI. So it will be a matter of core inflation falling faster than the goods inflation that we've seen.
So when I give me the equity perspective then, when do risk assets sell off?
Yeah,
do they ever?
It's a great question, and you have a valid point given since October 27th, we've moved up now after today probably 27% in almost a straight line in the S&P 500, no 5% correction or more. It is something that rarely, doesn't happen often, but really if you look at the law of averages, any given year, 1 to 3 corrections are the norm in the 5 to 10% range. And it's hard to see what would be a trigger for that, given we got today, which could have been a potential trigger for volatility. But we do think volatility is going to happen at some point this year. And in fact, the higher beta parts of the market, your mega cap technology, they will probably experience more volatility. And we still think that broadening of market participation happens.
Right, and we're kind of seeing that with the equal weighted index also at a record high. So in your world, Ken, what assets are still priced for, a recession versus what are priced for what we have now, which looks to be a soft landing in Goldilocks, and does that create an opportunity?
The commercial real estate market is one of the only markets out there that you can say is basically pricing in a really deep, dark recession. So we think that there's opportunities to be had not only in the bond market, but in direct lending. It's very popular these days, private credit, private debt. But if you're going into those corporate-related funds, they're pricing in Goldilocks. Everything's great, no recession, soft landing, no landing. If you go into the real estate market, valuations are down. So you get to lend on property values that are down. You are in control as a lender. You can make demands. It's a lender's market, right? It's not a borrower's market. You go into the corporate credit markets that have been on fire. It's a borrower's market. So we like lending and buying debt or owning debt into this new regime of commercial real estate where people are pricing in these bad scenarios. I like to invest into kind of the worst case scenarios, right?
Just as long as you don't need the cash right away anytime soon, right? Not very liquid. What about cash? Because for so long it became, not for so long, during this upswing in rates, cash became its own thing and became very attractive to a lot of people. How attractive does it look right now?
Well, with the inversion of the yield curve, you're getting paid more money in T-bills than you are in longer-term treasuries. So it's no surprise that many investors are sitting in cash and not coming out the curve. And the opportunity cost, if you weren't invested, was very high pre the Fed hiking. Think about all those years in QE with 0% cash. If you weren't invested, you were earning nothing. That's why we have the whole "there is no alternative" or TINA mantra. And that's just not true these days. You can sit in cash, and if you want to take a little bit of risk in the bond market, you can get 6-7% type returns in intermediate term funds. So it's a very attractive place to be.
And quickly, Mona, do you see the $6 trillion of cash sitting in money market funds making their way back into equities?
Yeah, we think that it will slowly and gradually get deployed. To Ken's point, yields are still pretty attractive, and what the Fed told us today, they're clearly not going back anywhere near the zero bound. In fact, they may stay closer to 3%, which typically implies 3.5 to 4% 10-year Treasury yield. That is an interesting place to be for a lot of investors. So as the CD money comes due, we think there's interesting opportunities, equities, but also in bonds. So that balanced portfolio makes a lot of sense still.
And commercial real estate. All right, Ken Shinoda of DoubleLine and Mona Mahajan of Edward Jones. Thank you both so much.
Thank you.
Thanks.